Good afternoon, chart Spartans. Have you all lost enough money? Because I know I certainly have. It's gotten to the point where I've even stopped recording my finances and net worth at the end of each month because I can't take the pain anymore. We all know we're heading for a recession. This might come later in 2023, or we might be in one now and we don't know it yet. Jamie Dimon believes we will have a hurricane, and every bank, investor, and YouTuber is predicting very much the same thing. Ultimately, skyrocketing inflation and energy price shocks have caused huge demand destruction that a recession really is inevitable. And we only have to look at the price shock in oil to see that this is the largest spike in oil since 2007. If we have a look at the stock market overlaid on this, we can also see that when the oil price shock last happened, that really did mark the top of the stock market. So given the really gloomy outlook for the stock market and risk assets, what I'm wondering is why I don't just sell all of my equities now. And the main reason I can think of, there are a few indicators, but the main reason I can think of is that we are in a fear market. And generally that's never a good time to be selling stocks. A month ago we were in extreme fear, and since that point we haven't even rallied that much from there. If we look at previous examples of when we were in extreme fear, the index made it back to neutral territory, that's a reading of 50, and even in some cases made it back to extreme greed. So in the worst case scenario, there could be a chance where we have a little bit more of a run to go on this rally. If we have a look at the stock market, we also reached an oversold reading of 28, and historically that has been a good time to be adding risk. That's certainly not what I'm going to be doing, but at least it allays my fears and prevents me from panic selling everything that I own. If we look at the last instances where the RSI was this oversold, we had 2020 when it marked the bottom of a correction. We also had 2011 when we were close to the bottom of a correction. We then had a double bottom with a bit of an overshoot to the downside, but ultimately it was a great place to not be selling stocks. Then we can have a look at 2008, and if we heeded that advice and didn't sell stocks, we would have got absolutely burnt. So it's not a perfect indicator, but generally when the RSI is this oversold, more often than not, it suggests that we're at the bottom of a correction rather than the top. Other indicators we have are the bullish divergence. We can see, if I go on the daily chart, we can see significant bullish divergence where price is making a lower low and the RSI is making a higher low. This suggests that the correction is reaching exhaustion and a turnaround is possible. If we look at previous examples of this bullish divergence, we can see there was one in 2020, which was a major buying opportunity. We saw that there was one in 2018, major buying opportunity. Again, in 2016, major buying opportunity. 2011, major buying opportunity. And even the bottom of the 2009 bear market, we saw bullish divergence, which was a major buying opportunity. So the bullish divergence is actually quite a strong indicator, but no indicator is perfect. Now, what other indicators do I have? We can have a look at the detachment from the moving average. So if I put the moving average on here with a scale of 200, we can see how far below the moving average we are. And generally, when a trend changes, assuming the trend has changed and we're going to make a series of low highs and lower lows, we would expect the price to then come back and retest the 200-day moving average. In the worst case scenario, if we are going for a repeat of the 2008 bear market, we can see that even then, price became very detached from the 200-day moving average, and then it reattached. It retested it and then came back down. So even in the worst case scenario that we're going for a major stock market crash, we should hopefully get an opportunity to reattach to the 200-day moving average, which will give us the opportunity to reduce our exposure to stocks. Now, the final aspect that I want to look at of the stock market is the overall bull market trend. So if we have a look at the current bull market, we can see that price is pretty much contained within this bull market trend. We finally got a blow off top, and without really retesting this bull market trend, we've just shot back down in a very sharp fashion. If we compare it to 2008, we saw again price remained underneath this bull market trend. It finally broke above in the blow off top phase. It retested it once, twice, and then made its peak before rolling over. We can also see that in the 2000 bull market top, we saw that the price for the whole bull market stayed below this bull market trend. It finally broke above in the blow off top phase. It broke down very much like what we're doing now, and then it remained above the trend before ultimately rolling over. And when price did finally roll over, it then did reattach to this bull market trend before tailing off. Again, in 2008, it reattached to the bull market trend before rolling off. And in the current phase, we have not yet reattached to the bull market trend before rolling over. So ultimately, the outlook for the stock market is very bad over the medium to long term. However, in the short run, given how oversold we are and how everybody is looking one way, I am not surprised if the stock market does the opposite and we see a significant bear market rally, potentially even making it back to all-time highs and completing a more rounded stock market top. It would make sense for us to reattach to the bull market trend at least once before rolling over. It would make sense for us to reattach to the 200-day moving average. And it would make sense for the fear and greed index to rise a little bit more before we finally roll over. So ultimately, I don't want to be panic selling here. In the worst case scenario, and we continue to make lower lows and lower highs, then I guess I'm going to be holding a bag. But I don't want to be acting in fear. Good luck with your investing. Pip pip, bye bye.